Welcome back to this channel for practice problems for actuarial exams. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. My advice on how to pass actuarial exams is at smarturl.it/pass. This video channel is at smarturl.it/pass actuarial exams. Here you have information about online seminars and study manuals for exams PFM, IFM, and LTAM that I offer. I direct the actuarial program at Illinois State University. You can find information about it at smarturl.it/actuary. If you would like to offer a tax-deductible donation to support our students, please go to smarturl.it/help ISU actuary. Our first lesson is about financial markets and financial assets. A real asset is an asset used to produce income, such as a factory, machine, or a patent. A patent is intangible. You can't touch it. It's a legal entity, but it produces income. And that's the point. A real asset is something that produces income. A financial asset is a claim on the income produced by real assets. Two most standard types of financial assets are bonds, or more generally fixed income securities, with the word security here being a synonym for financial asset, or stocks, and stocks, so bonds and stocks. Bonds make a promise of a payment of some type, and stocks pay you in relation to the income produced by the entity whose share the stock represents. So stocks are also called shares as well. And they represent ownership in some enterprises. The enterprise produces some profits. Profits are distributed to the owners who own the stocks of the company or shares of the company, and they are distributed in the form of dividends or indirectly through capital gains, where you buy the stock for a lower price and sell for a higher price. And the income from a bond is supposed to be at least reasonably certain, while income from a stock is quite uncertain. It's more risky. Another type of a financial asset is a derivative security, which is a financial instrument, another synonym for a financial asset, that has its value determined by the price of something else, such as stock, stock market index, bond, commodity, interest rate, etc. And commodity here means something like orange juice or gold, or things that we own that we typically own for the purpose of consumptions, but they are used in production as well. All derivative securities are created as contracts between two parties, a form of a bet between the two, with the sum of what the two sides make from the deal being always zero. So that what one side makes, the other one loses. An important feature of a derivative security is that, depending on the context, it can serve to either reduce risk or induce risk, and typically one side of the deal sees its risk reduced while the other side sees their risk increased. But it is possible to envision a contract that reduces risk for both sides. For example, when a producer of corn makes a deal to deliver a specific corn amount, I should say, at a specific fixed price in the future to a producer of cornflakes who uses that corn for production. Financial assets are traded in financial markets. These markets can exist in the form of one-on-one private transaction or organized around dealers, like the market for used cars, or a structured, organized and centralized exchanges such as New York Stock Exchange, CME Group, formerly Chicago Mercantile Exchange, also including Chicago Board of Trade and Options Exchange that CME acquired in 2007, or Intercontinental Exchange known as ICE. Trades on the exchanges are cleared through clearinghouses such as the Depository Trust and Clearing Corporation, its subsidiary National Securities Clearing Corporation, CME Clearing, or ICE Clear USA. And basically that clearinghouse exists for the purpose of making sure that both sides are paid. Derivatives clearinghouses clearinghouse typically interposes itself in transactions, becoming the buyer to all sellers and the seller to all buyers. So it's a form of dealership, really. Such substitution of one counterparty for another is known as novation. Large trader can trade many securities directly with a dealer in the so-called over-the-counter market. But the exchanges are more organized in a sense because they make sure that there is a continuous market, and dealers trade when they have inventory. They can't just trade any way they like. So when you're dealing with a dealer, this is called over-the-counter market. Measures of market activity are trading volume, so number of trades, market value, notional value in reference to the so-called notional amount in derivatives, which measures potential exposure, open interest, total number of contracts outstanding, especially for derivatives. The largest stock markets as of 2011 were New York Stock Exchange, or NYSE Euronext, that's in the US, NASDAQ, OMX, that's also in the US, Tokyo Stock Exchange, London Stock Exchange, NYSE Euronext in Europe, and Shanghai Stock Exchange. Large derivatives markets are CBT, CME, New York Mercantile Exchange, Eurex, Chicago Board Options Exchange, International Securities Exchange, Electronic in the US, London International Financial Futures Exchange. There are also exchanges headquartered in Australia, Brazil, China, Korea, well, that's South Korea or Sane Korea, Singapore, and other places. What are derivatives used for? Well, for risk management. The process of reducing risk with derivatives is usually called hedging. Speculation, traders who specifically seek higher risk in pursuit of high return. Reduced transaction costs. Trading derivative contracts on market indices has lower transaction costs than trading individual securities for basically the same value of securities. Same value and same composition. It's just that you can trade the whole index instead of individual securities. And regulatory arbitrage, ways of circumventing badly designed regulations. There are various perspectives on derivatives from different market participants and users, market makers, participants who create derivatives desired by end users, and economic observers, including regulators. The process of creating of derivative securities is often termed financial engineering. If you are trading through a dealer, the dealer will sell you a security at a different price, which is called the offer price or ask price, than the price the same dealer will want to pay, which is called the bid price. Pay you for the same security if you sell to the dealer at the same time and under the same circumstances. The difference of these two prices is termed the bid-ask spread. So it's like if you sell your car to a used car dealer for, say, $500, you come back next week, the car is for sale, you look at the price and it says $1,000, and you say, well, how can you do this? You just paid me $500 and you're selling it for twice as much. Well, yeah, because that's how the dealer makes money. So the difference of the two is called the bid-ask spread. If you buy through an exchange, the bid-ask spread is smaller, or almost zero at an exchange that works to create continuous trading with floor traders like New York Stock Exchange. Investors also pay commissions to brokers and other transaction costs, for example, taxes. Some ways to buy or sell. A market order is executed at the current price in the market. So you don't exactly know what it will be because you just say buy at whatever the price is, or sell at whatever the price is. A limit order is an instruction to trade a security at a specified or better price, better for you. So if you're selling this price or higher, and if you're buying this price or lower. A stop loss order is an order where you sell once price reaches a specified level. So you have a stock that's worth $100 and you worry that it will drop a lot. So you say, if it drops to 90, sell it, no matter what. And this way I'll avoid its price dropping to 50. A short sale is a sale of a security which is borrowed from a broker, with that security replaced later by a purchase, which is called covering of a short. Short sale requires a deposit, a margin deposit, of a certain amount of money, typically 50% of the amount received from the sale of the security, but on the exam it will be always specified what the margin requirement is. This margin deposit may or may not earn interest with the broker. The money received from the sale generally does not earn interest and is held with the broker until the short is covered. A short sale creates new supply of a security shorted, so if the shorted security pays income, for example dividends, that income must be produced by the short seller in order for the holder of the newly created security to receive such income. In general, the payment that has to be made on a borrowed asset is called the lease rate of that asset, or asset lease rate. Main reasons for short selling are speculation, financing, that's a way to borrow money, this is common in bond trading, and hedging, which means in some way balancing the risk of what you have with the risk of what you sell. So you hold a certain security, you have a position in it, and you use another security to sell it so that your risk of that security that you're holding is erased or reduced. That's called hedging. An issue that arises in short sales is the calculation of the rate of return received by the short seller. In such a calculation, we should note that the rate of return is determined by the initial cash outlay of the investor and the final cash flow received at the end when the short is covered, as well as possible intermediate cash flows of dividends paid by the investor and interest received. General formula for the effective yield earned over the period of investment is the yield I is P, which is a profit on the short sale transaction, so sale proceeds minus short covering or repurchase cost, plus I, which is interest earned by the short seller on the margin deposit, assuming there is no interest earned on the cash received from the short sale. If there is such interest, then it must be added here, minus D, which is the dividends paid by the short seller to the newly created securities owner, and M is the margin requirement, initial cash outlay by the short seller. So M is how much the short seller spends, and P plus I minus D is how much income he or she receives from the transaction. So obviously that money divided by M is the rate of return over the entire period of the transaction. In the case of short selling through a broker, margin requirement may be imposed by government regulation. But short selling can also be arranged as a private transaction in which you borrow an asset privately, sell it, and promise to return it in the future to the owner from whom you borrowed it. This creates a risk to the said owner that you will renege on the obligation to return the borrowed property. In order to manage that risk, the owner can hold the funds obtained from the short sale until you return the property, but even that may not be enough due to price fluctuations of the asset. The owner may ask the short seller to provide an extra amount, which is similar to a margin deposit. In the case of such a private transaction, that extra amount is called a haircut. Will you receive interest on the money held by the owner? This is not common with individual clients of registered brokers, but in the case of private transactions between larger institutional investors, interest is usually paid on both the short proceeds and the haircut. That interest rate is called the repo rate if the property sold as a bond, and short rebate if it is a stock. It may not equal to the market rate of interest that you would otherwise receive on the funds, though, and this creates another cost to the short seller. One more issue in a private transaction short selling may be the payment of dividends or any other income produced by the assets sold short. The interest rate at which such dividends or income are produced by the asset sold short, which the short seller must pay to the original owner of the asset, is called the lease rate of the asset, or asset lease rate.